headlines about rising interest rates and high inflation, just how high could central banks continue to raise interest rates? As they continue to climb, this is a concern that has been on everyone's mind lately. After all, this will continue to impact your finances and the economy. The central bank, also known as the Feds, is basically a financial institution that is given the power to be the boss of all the other banks in the country. They're responsible for making sure that the economy is healthy and stable. They do this by controlling how much money is being printed and by influencing the interest rates that determine how much interest people have to pay in order to borrow money. One way that they do this is by controlling the federal funds rate. This is the interest rate at which commercial banks borrow and lend their excess reserves to each other in the overnight market in order to maintain their reserve requirements. The reserve requirement is usually a percentage of deposits that commercial banks are required to hold so that customers can access cash if needed. There is also the discount rate. This is the rate that commercial banks have to pay in order to borrow money from the central bank. Central banks lend money to commercial banks, and commercial banks lend money to the public. Rising interest rates means that the cost of borrowing money is increasing. By increasing or decreasing the reserve requirements and the federal funds rate, the central banks can influence the cost of borrowing. So an increase in the federal funds rate means it's more expensive for banks to borrow money from each other. And because of this, they also have to charge borrowers more interest on their loans and vice versa. The same scenario applies here for the discount rate. If central banks increase and charge higher interest rates to commercial banks, then commercial banks will do the same when lending to businesses and individuals. So as rates go up, lenders like banks who lend money out can charge borrowers, everyday regular people and businesses, more money for borrowing, leading to people spending more on their interest payments. Central banks raise interest rates for a variety of reasons. When inflation is high, this refers to the prices of goods and services increasing. Central banks may raise interest rates. This is because one of the main roles of the central bank is to make sure that price stability stays under control. So as inflation increases, they have to raise interest rates as a way to help encourage saving and less spending, while also help reduce the need to borrow money. Central banks may raise interest rates to manage economic growth, usually during times of prosperity. This is because as more people have jobs and more money to spend, consumer demand for goods and services will also increase, leading to businesses who offer those goods and services to increase their prices, which can lead to inflation, as the purchasing power of your money will drop. As rates continue to rise, these will affect our borrowing and lending activities. For example, let's say you want to buy a car or even a house and need a loan to finance it. Well, now the amount of interest you will pay will be higher than it would have been before the rate increase. Also, for individuals who have already taken out variable interest rate debt, such as credit cards, the rise in rates will increase their monthly payments, making it harder to get out of debt. As rates rise, the bond market will automatically be impacted. The price of existing bonds will need to decrease enough to match the new yield on the newer bonds. Since yields are higher now, new bonds will be more desired, meaning higher interest, coupon payments, and more money to the investor. After all, why would an investor buy a bond that offers 5% interest when they can go and get one that offers 7% interest? The stock market can also be impacted as rates rise. This is because the borrowing costs for companies will also increase, making it more expensive to maintain their debt, which can eat into their profits. As a result, because of the higher rates, companies that rely on borrowing will more likely be more hesitant to borrow money, which will limit their growth. Additionally, higher rates means consumers will have less money to spend because of the need to save more money, or because it's more expensive to go out and borrow money. This will decrease the demand in the goods and services offered by corporations, also eating into their profits, which could cause their stock prices to fall, especially in the short term. However, as historical data suggests, over the long term, healthy companies' stock prices should continue to improve and recover. Rising rates can also impact the housing market, making it more expensive to buy homes because of the total cost of having a mortgage will increase as rates rise, which will lead to a decrease in the demand for the homes and possibly lead to a decline in home prices. Those with adjustable rate mortgages, also known as ARMs, will suffer compared to those with fixed rates as rates increase. The increase in their monthly mortgage payments will also rise because of this. A savings account or certificate of deposits offered at your local banks or other financial institutions should now offer higher rates, which will help you earn a little more income on the money you have saved. Having debt with a variable interest rate like credit cards can be very frustrating, especially during times of high interest rates. Here's what you can do to focus on paying it off. Attack the card with the highest balance first and then work your way down. You can also consider refinancing to a fixed rate loan so that you can lock in a lower rate. And if you have investments in stocks and bonds, you can rebalance your portfolio and maybe even hedge with options. As we have discussed, higher interest rates can have a significant impact on the economy, as higher interest rates can lead to higher borrowing costs and a slowdown in economic activity. High rates can also be a sign of a strong economy. As with any economic trend, they come and go, so stay informed and stay prepared. Anyways, thanks for watching. If you found this video helpful, do me a favor, hit that subscribe button for me, and I'll catch you guys in the next video.